Evening, everyone. I'm Ed Rimmer, Chief Executive of Time Finance. James is my colleague. He'll be on shortly to take you through the interesting part, which is the numbers. Myself, I've been in and around lending to small businesses for nearly 30 years. A good chunk of that time was with Bibby Financial Services, where I spent 5 years as Chief Executive before moving into this business. Some of you may know a business previously called 1PM PLC. That is now this business. It was rebranded 4 years ago. So that's me. James will introduce himself when he comes on. We're conscious of time, so keen to just get into the presentation. So an overview of the business and what we do. We are what people now refer to as an alternative finance provider. What does that mean in practice? Well, we're not a bank. We're an independent business. Our job is to go and find money as cheap as we can, which generally comes from the retail and the challenger banks, and then lend it on in a margin to our audience, which tends to be now all small businesses. The key products I'll come on to in a minute. We support just over 10,000 UK businesses, all SMEs, typically turning over new start businesses from nothing, typically up to around £10 million. We lend anything from £1,000, very small end, up to £3.5 million. That's our market. We predominantly lend on our own book. We have the flexibility to broker out deals which don't quite fit within our credit profile. And importantly, we have a multi-product offering, which includes asset finance, invoice finance, loan finance, and a combination of all three. Our core products are asset finance and invoice finance. So very briefly, what do they mean? So asset finance, commonly referred to as HP and leasing. So typical clients will be construction companies, plant hire, hauliers, businesses who have a capital equipment need. They can't afford to pay for the goods straight away, so they lease them or hire purchase. And for that, obviously, we charge interest rate. Invoice finance is slightly different. It's an alternative to a bank overdraft, so it's more cash flow lending. Businesses that need to grow and expand, they wait for businesses to pay them 30, 60 days. They have to pay wages out and goods costs and everything else that goes with running a business. And they use effectively a bridging facility, which is invoice discounting and factoring. We get our business from third parties in both products, so brokers, insolvency practitioners, accountants and the like. The deal size, as I mentioned before, minimum £1,000 in very small asset finance businesses up to £1 million. And then we'll go up to a higher level for invoice discounting and factoring, all the way up to £3.5 million. But it's still very much focused at the small to medium-sized enterprise end of the market. Typical yields, anything from as low as 9%, but that comes really with the higher quality, bigger deals, typically up to sort of 18, 19%. And our funding comes, as I mentioned, from wholesale block funders who are either challenger banks, alternative funders themselves who have been in that leasing market for a while, or in our case, the British Business Bank, who are our largest funder in the asset finance business. And in invoice discounting, it comes from one of the high street banks on a back-to-back facility where we've had that relationship for over 10 years. Very, very briefly, I'll put this confusing slide into words. How do we compete and where do we stand in the market? So at one end, you've got banks. At the other end, you've got very small owner-manager businesses. In the middle, you've got businesses like ours who are alternative financiers. We can compete with the banks who have a wider product set because we have asset finance, invoice finance, loans, vehicle finance. But what the banks tend not to have, as everyone typically knows nowadays, is flexibility, speed of response, access to decision makers, and that whole agility that comes with having small businesses. The businesses that we compete with at the lower end of the market tend not to have the products offering that we have. So we're very much a business that prides ourselves in being flexible, personable, agile, but we've got the product set of some of our larger competitors. We're not completely unique, but we're in a bunch of finance providers who are reasonably unique in terms of that mix of product set and focus on service. Some numbers, well, we have just over 10,000 UK customers and clients. We provided or arranged over 85 million of funding to UK SMEs in the last 12 months. 63 million of equity on the balance sheet with net tangible assets of 34. There's quite a bit of goodwill that sits on the balance sheet in relation to old acquisitions. and 30% growth in PBT and EPS over the last 12 months. We've won some awards. We like to think that we've repositioned Time Finance from the 1pm days in the core markets that we intended to do, and that's resulted in some nominations and some awards that have been won, and that's testimony to the great work that our 150 people do behind the scenes. We put a plan in place when I came back into the business 2.5 years ago, which were based on 4 key themes. The first was to become a nationally recognised SME funder. That wasn't as a household name, or to be fair to the retail market. It was very much focused within our corporate finance space, so in the commercial finance broker market, because 1pm prior to this was a mishmash of brands and people didn't really understand what each did. So that was very much on the back of the rebranding exercise that happened at the end of 2020. The second objective was to more than double our gross lending book from where we started, 115 million. We'll come on to where we are. To achieve profits organically back to pre-COVID levels, and to significantly strengthen our balance sheet through focusing our own book. The business, when it was 1pm, was a mix of broking, consumer finance, and business-to-business own book. Our focus over the last 2.5 years has been very much on growing our own book in the business-to-business lending space. And as a result of that, we've tidied up some of the businesses that weren't core to what we now class as core business. So the progress to 30th of November, our year end is May, so this is the first half of the year. We've grown the book to 189 million. The bottom row shows the growth since the financial year. The top row in terms of the arrows shows the growth from when we put this plan in place. So you can see there that all positive figures, 60% growth in our lending book since we put this plan in place 2.5 years ago, driven really by our 2 key products offering. Hard asset finance. Hard assets are businesses that have got a residual value at the end of the lease. So things that you can relate to: diggers, tractor units, trailers, printing equipment, bigger assets that you can either repossess and sell into a market if you need to, or at the end of the lease you've got value to them. And Invoice Finance, I've mentioned that. There are 2 key products, and you can see the lending books there, both of which have grown more than double since we put the plan in place. Between them equate for nearly 3/4 of our lending book now. So that's where the focus has been on, and those markets have been pretty good over the last couple of years. Some other figures, the unearned income within our balance sheet, 24 million. So that is the income that's attached to the leases and loans that we effectively lock into our lending book. As long as those customers repay over the 3 to 5 years, however long the lease is, that's the income that we'll receive over the next however many years the leases and loans last for. Why is that important? Well, obviously it gives us visibility of income coming into the P&L, and you can see there that it's increased from 14.3 million to 24 million from 2.5 years ago, and the growth has been good as well from the start of the financial year. The own book versus broked on, it was 87-13. Actually, going back in time prior to the conceiving of this plan, it was more 75-25. So you can see how the business has transitioned to become very much focused on own book. Nearly 100% of our lending is now within our own book, but we still have that ability to broke business out if it doesn't quite fit within our credit quality. And importantly, one of the key things for these businesses is that James always says it's quite easy to lend money. The key is getting the money back. Clearly, that is important to us. In COVID, times were obviously more challenging. However, there was a silver lining of all the government schemes. Whilst it suppressed a lot of our new business, it meant that people could tap into loans to keep our repayments coming through. So whilst we saw arrears increase, they were actually a lot higher than that at the peak of COVID. They've come down to 6% over the last 18 months, and we're pretty proud of that, because whilst we've expanded the business, we've kept the arrears fairly consistent with the growth in the book. So long may that continue. What have we done? Well, we tidied the business up. That's the key thing. We did have some non-core businesses. We exited those in 2022 finally. We also exited a small unsecured loans business. Some businesses, I'm sure some people will have heard of the fintech businesses, so the likes of Funding Circle, iWalker, all those personal guarantee-based loan businesses, that's not what we do, although we did have a small book that effectively competed with that. That's why we exited that business in December 2022, because it wasn't consistent with what we do, lending to businesses under secured lending. So we tidied the business up, we slimmed down the locations. There used to be 7 locations. We're now out of 4 locations, Manchester and Warrington in the north, Bath and Reading in the south. We also brought some new people into the business. We brought a new head of director of asset into the business 2 years ago. He's made a real difference to that division. He had a lot of hard asset experience, and that's one of the reasons why we've focused on that market, and it's been a big expansion. We brought a new head of credit into the business who helps us do some bigger and better quality deals, and new head of group operations who actually helps us with the next point below, which is moving into some different products, helps us launch the asset-based lending proposition, which we launched in April 2023, and that effectively is taking a combination of all our products and being able to offer those to the same customer, which makes the yields better, and it means that clients generally stay with us for longer. And just to finish off the sort of tidying up exercise, the soft asset business that originally this business was conceived out of in Bath, we've changed. It's a smaller part of our business now. We've made it more auto approval, and that's now badged under a fast track offering. That's performing well, relatively small part of the business, very well spread, but brings with it a higher yield of around 18% plus. And finally, we've continued to build on our brand. We've sponsored some industry events. We've sponsored the National Association of Commercial Finance Brokers over the last 2 years. And we were ranked number 1 in the Business Money Intermediary Index in terms of the people we get business with. So a lot of change in 2.5 years, a lot of tidying up, a lot of refocusing the business, and that positively has fed through to some good results, which I think James will take you through now.
Thanks, Ed. Thank you. Good evening, everybody. I'm James Roberts. I'm the CFO. I've been with Time Finance now for coming up to 7 years in this role. As Ed touched on, our year end is May. We just recently, last month, released our 6 months unaudited results to November, and those are the numbers I'll talk through now and give you a bit of history as well around arrears and the spread of the business, etc. So, as Ed's mentioned, we're keen on growing our own book, and the reason behind that is own book lending for the right types of deals was key to drive revenue and in turn profits over the months and years that the length of the lease and the loan. It's one of our key focuses, and as you can see here, we launched the project, the medium-term plan in June of 21. Down in the bottom left-hand corner, the book was about 115 million. And we've grown pretty much month on month, certainly quarter on quarter. There's always been growth all the way through now to the end of November. We're just under 190 million. As Ed alluded to, one of our strategic goals was to double the book by May 25 to over 230 million, and we're ahead of target on that. So the book is absolutely key as long as you get your lending right, and so it's the first thing we look at on the financial side. But you can see that there is demand among UK SMEs. They've been remarkably resilient. Despite the doom and gloom everybody here may hear about the economy, the UK SMEs have been remarkably resilient, and there's continued demand for assets and invoice finance. And this has led through to our P&L. The bigger the book should drive increased revenues, which should drive increased gross profit and in turn profit before tax. And these are the 5-6 month periods of our medium-term plan. And pleasingly for us, you can see every one of those 3 metrics. The purple bar is revenue, the sort of green bar is gross profit, and the light blue bar is profit before tax. They've all increased half year on half year on half year all the way through. We've grown the revenue for 6 months to the end of November 23 from just under 12 million to just under 16 million from the beginning of the plan. Gross profit from 7.5 million or so to about 9 million, and PBT from just over 1 million to 2.7 million. So there's significant growth in the P&L coming through from that larger book. And this is shown on some of the numbers here. These are the key financial metrics we show. Own book origination, this is the lifeblood of the business. If you get the right numbers of deals coming through and they're the right quality, That will lead to the increased book, which in turn will lead to increased revenue and in turn increased profits as long as you write the right type of deal. And I'll come on to those in a second. So as long as that lifeblood is growing and you've got more coming in at the front end of the right quality than is being repaid, that'll feed through to an improved P&L. So we can see for the 6 months to November 23, compared to a year before, we've got nearly 30% growth in own book origination, just over 47 million. That's led to the book, as we touched on, just under 189 million, up from just over 150 million 12 months before, so that's 24% growth. And that's led to this unearned income balance of just under 24 million, itself 26% up on the 18.9 million before. And as Ed mentioned, unearned income's quite key. If we close the door today and never wrote any more business, as long as the deals performed as we thought over the coming months and years of the length of the life of the lease or the loan, that income would fall due. So we start the new financial period with 24 million of revenue in our back pocket effectively, as long as they perform well. Again, stealing Ed's words, because he stole mine, it's arguably quite easy to lend money. He says flippantly, the skill is in getting it back. And so arrears are absolutely key for us, and I'll come onto a graph around arrears as well. Now, arrears, crucially, are not deals that are going to be written off. I want to say that. We haven't got 6% of our book that's going to be written off. These are simply deals that, for whatever reason, have not quite paid as planned. It could be somebody's gone on holiday and forgot to pay us for the month. And we pick up the phone when they come back and they pay us and it comes back online. We cure it. But crucially, we can see the arrears percentages stayed the same. So although we're adding significant amounts to the own book lending, we're doing it to the right type of clients. They're clients who fit the lending profile we like and invariably will pay us back and we get our money back. So as I say, we haven't seen arrears spiking despite the growth in the book. So the quality of the book has remained the same as we've expanded. And that's led to an increase, strengthened balance sheet. We can see our tangible net assets are now nearly 64 million, 7% up on the year before. Arguably more important, well, in my opinion, definitely more important, are the net tangible assets figure. There is a bit of goodwill on the balance sheet, a sizable amount of goodwill. So the key figure for us is net tangible assets, 36.4 million. That's 13% up on 12 months before, which is good growth. And that's driven from the P&L revenue, as I touched on, up nearly 20% to 15.7 million for the 6-month period. Profit up 35% to 2.7 million. And our EPS also up 35% to 2.33 pence per share. So as you can see on the far right-hand side, a load of green ticks. They're not green, actually, sorry. A load of ticks. Really good set of 6 months numbers that we're quite proud of and sets us up for the final half of the year, which we're cautiously optimistic of doing well in as well. Just some other stats. Being an own book lender, the balance sheet is absolutely key. And we feel we've got a very robust and strong balance sheet. You can see on the left-hand side that since the beginning of the plan, and actually forever, basically, we've always made money. Despite COVID, despite whatever storm has come our way, this business has always made money, and we're back to making much bigger profits than we were at the beginning of it. So you can see that over the period of this plan, 2.5 years, our net tangible assets have gone from over 28 million to now nearly 36.5 million, and every month they continue to increase reasonably significantly. So 36.4 million net tangible assets. And this is probably the key graph that I'm going to chat to you about today. This is the arrears. As I mentioned, this isn't write-offs. This is just deals that are in need of some remedial action, anything from picking up the phone and saying, can you please pay, all the way through to maybe high court enforcements or something like that to get people to pay if they've gone wrong. You can see on the left, the beginning of our 4-year plan was the tail end of COVID, June 21. You can see arrears. The bold purple line is the overall group arrears. We're just over 12%. And then since the introduction of the plan, we focused on the tail end of COVID going out and then writing exactly the right type of business. And you can see for about the last 18 months or so, when you round it to the nearest decimal place, it might be a little bit up, a little bit down, but on average, for the last 18 months, arrears have remained static at 6%. So we've grown that book significantly from 115 million to 190 without any reduction in quality and arguably a big improvement in quality. As Ed mentioned, our two key growth areas and our two key areas of focus are hard asset and invoice finance. And these other two graphs here are those two areas. So they're the key areas that we're growing the business. They now make up 75% of our book. And actually in new business, they make up over 80%. So they'll become more and more pertinent over time. And you can see the hard asset has reduced from over about 15% to now between 3 and 4% arrears. and the Invoice Finance business has gone from about 4% to about 2%. So the growth areas actually have a much higher quality than in some of the other areas, such as soft assets or loan asset, which are no longer a focus. So arguably, we should see that continuing to improve in terms of the quality of the book. We can only do what we do because of our funding partners. We feel we're quite well funded. We have a number of longer-term supportive funders who've been with us for a while. We also have a very diversified funding base, so we've not jumped into bed with just one person. We haven't nailed our colours to one mast. We've got a number of funding partners who back us. They're all very supportive and offering bigger and better facilities all the time. But as you can see there, we've got about 160 million of funding facilities in place. The usage at the moment is just over 110 million. So there's 50 million of funding available to grow our book for the remainder of our plan. And we've got some reasonable funding partners behind us, the British Business Bank, RBS Invoice Finance, NatWest, Aldermore, people like that have all got facilities in excess of £30 million with us. So we've got a number of funding partners. Very quickly, some other key metrics before I hand back to Ed, conscious of time. We've increased the average deal size from about 14,000, to over 40,000 during the course of this plan. Have bigger and better clients, more secure deals. That's what's improving that deal, in those arrears rates as we were talking about. We've also continued to focus on spread. That's absolutely key for us to not be wedded to one particular sector or industry. We're very well diversified across the whole of the UK economy. No one sector accounts for more than 10% of our lending book, and the top 10 account for less than a third of our lending book. So we focus on being very, very well diversified and very well spread. And we think we've got a very sensible approach to provisioning. Our bad debt provision continues to represent about 3% of our net exposure. So we've got 6% potentially in arrears. We've got provisions of 3%, and very consistent, we have write-offs of about 2% and recoveries of about 1%. So arguably our net bad debt write-off each year is about 1%, and we have a provision sitting there of about 3%. So we think we're very adequately provided for the current macroeconomic environment. And with that, I'll hand back to Ed.
Thanks, James. So according to the screen, I've got 1 minute left. So I'll fly through this. So in summary, we've very much tidied the business up effectively from the 1 p.m. days. Focus on B2B lending, focus on hard asset and invoice finance, and maximising our multi-products offering with an expanded product range. We've brought some people into the business. We've controlled arrears well, particularly in a difficult environment over the last 12 months. The profile of the business under Time Finance has increased, and it's nice to see that that's reflected in a positive financial performance. I think in terms of the outlook, we continue to deliver the strategy as we're doing for the next 18 months until we go into our next phase. We expect still to see growth this year, despite the difficult climate. And I guess the key message to leave people with is that everyone assumes that it's really, really difficult for small businesses, and it is. But that tends to be where people like us do well. We do really well in times of bust and boom. We don't do as well when it's sort of mundane. In times of bust, people need cash to survive, and in times of boom, people need cash to grow. And that's where we come into our own. So whilst there's challenges around credit quality, we believe we've got the people and processes in place to manage that robustly. Our opportunity is businesses that need to borrow, and I think that's where we are now as an environment. So the business has done well, the financials have reflected well on our share price, and it's pleasing to see that we've increased our share price in the last 12 months by about 70%. Without further ado, that is it. A whistle-stop tour of Time Finance. Thank you.
James, thank you very much indeed. Thank you.
So as I said earlier, if you have a question, please raise your hand, and my colleague will come over the microphone. First hand here, please. Chris, thank you.
Hi.
Hi.
Can everyone hear me?
Yeah.
Perfect. So what is your net interest margin? What is the average duration of your loan? And whether you have a ceiling on the amount of leverage you can take on your balance sheet in terms of loan book to the equity that you've got?
It's probably one for me, isn't it, Ed? Yeah. Okay. Yeah. So our net interest margin is around about 9% on our lending. So we'll borrow around about 7% or so, and we'll lend out, depending on the quality of the deal, between 10 and 20, but on average, I'd say it's about 14, 15%. So it's 6-7% or so is our NIM. There is a bit of pressure on the NIM because of competition and things like that, so you've got to pick the right deals and the pricing, but our NIM is healthy. We think our NIM is pretty good. In terms, there was a second point, sorry, before the leverage point. What was the second one?
The average duration of your loan.
The average duration of the loan, yeah. So big split between Invoice Finance and Asset, the two products. Invoice Finance tend to come in for 2-year deals, and then we renew the facility every 2 years. So, and we have very good retention rate with our Invoice Finance clients, but it's a 2-year facility once you've got them in place. In terms of Asset, we will lend between 3 months and 6 years, but it's very much a bell curve, and the vast majority are 3 to 3.5 years or something like that. So most leases and loans, 3 to 3.5 years. That's probably very much 80% of what we lend. And then in terms of leveraging, we put in between 10 and 15% in each deal cash into each deal ourselves, and our funders will provide 85 to 90% on the back end. So we're only about 3 times geared. Our gearing covenants are all about 6 times, so we've got ample room to leverage further up in terms of putting our cash into the business and our funding being utilised, and in terms of the gearing covenants on the balance sheet.
Are you going to get to a limit at some point? If you got, I don't know, 40 million pounds of equity, can you sustain a 400 million pound loan book, or do you need to stop at some point? Or can you go like 2005 Goldman Sachs when you had 30 times leverage?
Well, we wouldn't want to be leveraged that highly. We're safe and secure. We're leveraged about 3 times at the moment, and we may go to 3.5 or something like that. We're not going to leverage to the hilt. That's in our view racier than we'd like to be. We can hit our medium-term plan and comfortably exceed it with the balance sheet and the funding structure we've got in place at the moment.
Question at the front here, please. Thank you.
Hi. I can see that your revenue has started going up as well, and you have partly answered the question that I was going to ask. But what is your debt level or the progress from what you started from June 21 until now?
The level of debt we've got on the balance sheet, yeah. So the balance sheet debt at the moment from our funding partners is about £100 million. It's just under £100 million. When we started the programme back in the medium-term plan, is that the period you're referring to? Yeah, back in June 21, it was the high 80s. I haven't got the exact figure. I think it's about 87, 88 million, something like that.
Okay, one final question, please.
Can you tell me, please, if you are in the same arena as Alpha International?
No.
No? Fantastic. Gentlemen, James, thank you very much indeed for joining us. Thank you for the presentation.